Hey everyone, this is Michael, and this is the Market Trend Advisory video for March 26, 2022. Before we start, here's our disclaimer, and please take a moment to pause the video and read this so you understand it. So let's go ahead and get right into the market trend. So we've just, in the last 9 days, we've had a complete reversal out of a bear market into a new rally. Now, we don't know if this is going to be a new bull market, if the bear market is over, but as of now, for the last 9 days, we've had a very, very powerful rally going on, which is surprising a lot of people. So just right now, we show that the market's in an uptrend. The uptrend is strengthening. We're showing that we should be adding exposure because our market count for the NASDAQ is now to 100%, which is very surprising because less than a week ago, we were basically at zero. So our market count's at 5 out of 5. Market exposure is 100%. We don't have any institutional selling days on either index, which is pretty remarkable. And then for our individual stocks and non-index ETF action signal, we're up to about 35% exposure. So you should be having some exposure to this market, no matter what happens going forward. The S&P is also almost as strong. The market count there is 4 out of 5, and we're at 90%. So let's take a little closer look at the indexes. So here's the S&P, excuse me. And you can see this was our follow-through day here, and we just came ripping straight up. The 50-day, even though it's in a declining 50-day, it didn't even stop the index, just blasted straight through it. We had another day, we had a little support there. The 200-day, which is this black line, still rising, did provide a little bit of resistance for a couple days, and then it shot past it, and now it's providing support. So technically, this looks very strong, and looks like it wants to go higher. So that's where we are for the S&P. So the NASDAQ, not quite as strong, partly because we did go into a bear market. I think we were down almost 22% down here, but we come shooting back up. The 50-day didn't really provide any kind of resistance, and looks like we're going to try for the 200, which is kind of flattened out a little bit. So that's very powerful rally going on and surprising everyone. We'll talk about that in a minute. Let's just do a little bit on our investing strategies. We are currently at 100% on Friday, which was yesterday. I think we moved to 100% exposure. And our current stats are if you're buying the QQQ since the beginning of the year and holding it, you're down 9.68. Our market count 2x is down 6.84. And the 3x, which has a lot of leverage, is just down slightly more than the QQQ. So we're off to a negative start for the year, but market rally continues. These will be turning quickly, turning positive pretty quickly. And for the SPY, we have a under 5% return on the SPY ETF, and a little market count 2x. And we're at 90% exposure. So both of these, we haven't had a new buy signal on Friday, so we don't have any action for Monday's new trading day. Okay, so let's get a little bit into what's going on here. And what's happening, this is a classic example of a market climbing a wall of worry. So far, 2022 has been really eventful in terms of risk. We see a lot of geopolitical turmoil. It spiked in February when Russia invaded Ukraine. This conflict sent already rising prices skyrocketing, and also for energy too. And of course, we all know that inflation has come back. It's hot with the CPI index jumping 7.9% year over year in February. That's the biggest increase since January 1982. We're going back a long ways there. And then on top of it, we have the Fed recently raised interest rates, and for the first time since 2018, in its ongoing effort to cool prices. And they've been telegraphing that they become more hawkish. Their original statement from Powell was that this is just transitory. They've taken that language out, and now they see they have, looks like, a bigger problem to deal with. And having interest rates at zero has not been helping. So we've seen, though, that the 10-year Treasury last week, it leapt 34 basis points to 2.49. So let's call it 2.5%. That's the highest since May 2019, and that's up from just 3 weeks ago. Actually, no, 25 days ago at 1.68. That is a huge move in the treasury market. You know, the bond market doesn't really move that much generally, and that's a gigantic move. And we're also seeing that the two-year treasury yield is rallying even faster, and we're narrowing the gap to just 20 basis points. So we're seeing a flattening treasury yield curve, which is inverted in some places, and it's reflecting that the expectations that the Fed's going to raise rates aggressively and that economic growth is going to slow. So normally you put all this together and you would expect a market that is going down and probably going down quickly. And because all these developments, you put this all together and it's all headwinds against economic growth and business activity. But what did we get? We got a huge, powerful rally in the market. So what's it doing? This is the market climbing a wall of worry. All these things are being priced into the market in real time. And the market, as of today, or Friday, is discounting all of this, looking out 6 to 9 months. So at this point in time, it's looking at all this and thinking it's not really going to affect the economy in the U.S. It's not going to affect stocks. Everything looks good, and up and away we go. Now, whether you agree with this or you don't agree with it, it doesn't really matter, because that's what the market is telling us. And there's a lot of things that a lot of times this has happened in the past. And this is one of the reasons why you subscribe to the Market Trend Advisory, because it's giving us an objective view of the market. And there have been a lot of times when, I know personally, I would not want to invest. The most recent one was the bottom in April 2020. I was like, the world has basically shut down. Everything's closed around the world. There's no activity. Businesses are closed. There doesn't seem to be any upside in the near future. And it was only a month later that this whole thing just came screaming back. And I just thought, well, maybe I'll wait for the next pullback, and it never came. It just came ripping straight up. But by using following what the market's actually doing, got back in and made some nice gains and all that. It's a huge move. So right now, it's just really hard to believe that stocks can keep going up, especially with bond yields going up. Usually the stocks and bonds trade in opposite directions. But one of the things, though, is that the market, especially in the NASDAQ, a lot of the gains has been coming from the mega caps. They became suddenly hot again. And we had pretty strong gains from Apple and Tesla, Nvidia, Microsoft, and Google parent Alphabet. And of course, these stocks, I don't know about Tesla, but a lot of them are in the SP 500. That's also giving it some strength there. And remember, these mega caps were skewing the market indexes higher, while a lot of the NASDAQ went into a really severe bear market. So I have a feeling that's part of what's going on here, is that they're jumping into the big players are going back into the mega caps, which sort of give them a degree of safety, or at least perceived safety, going forward. So what I want to do this really quickly is take a look at a precedent. Now, this is the market today, and you can see we've had a couple waves down. We had our first wave here. The second waves are usually a bit longer. That's traditional, and you see 3 waves down. And we had our sort of third wave down and bottomed. So a precedent of kind of a similar thing, this is from 1998. Now, we did have the same thing. We had a initial leg down, a little sharper leg down, and then it was even sharper leg down for the third wave, and then it came roaring back. Now, 98 was a whole different kind of picture, but if you compare the charts, they do look somewhat similar. Now, at the bottom here, we had the Asian financial crisis was going on, long-term capital, the hedge fund run by all these Nobel Prize winners and, world experts just collapsed. And that was giving the market a lot of worries here, but it just came ripping right back up. Now, interest rates back then were higher. We had a little bit different. There wasn't any inflation, so every market cycle is a little bit different. But the precedent is that this just kept going and ripped off to new highs. Now, do we expect that this can happen here? No, but anything can happen in the market. If it's already discounting the future, it's saying that we doesn't really see any problems going forward. Now, that could just be for now, and we could turn around. This could be just a bear market rally. You do get these really powerful rallies in bear markets, but that's sort of unknown. So, in our system is telling us we should be 100% invested on the Nasdaq, at least on those tech stocks and things, or at least on the indexes for the QQQ, or in our system the QLD or TQQQ with our investing strategies, and almost there for the SPY. So, and we're getting also a lot of stocks are breaking out, and not the former leaders. A lot of those leaders like Tesla, not Tesla, sorry, PayPal and Square and Shopify, Atlassian, a lot of those stocks are broken and probably won't come back for years, even though they're starting to look like they want to bottom out. But there's been a whole new crop of leaders, and we've been seeing them more in the commodity sectors, especially oil and gas, some chemicals, some of the cyclical sectors like that. So going forward, it's been clear, the Fed has already made it clear that they're going to be raising rates aggressively. But when they came out with their statement last week, which sort of triggered this huge rally, they kind of were clear about what they were going to do, and that just took away a lot of the uncertainty and fear. And the fear level had hit panic levels. You can go back and look in our big database, and the CNN fear greed hit panic level for a couple of days, and it was extreme fear for about a week. And then we also saw from the Investors Intelligence newsletter survey, I don't have the charts in there, but we talked about this in the daily notes. The number of bulls and bears, right now they're actually even, but the number of bears actually crossed below the number of bulls. And that doesn't happen very often. It last happened in April 2020 for that big rally. So, and it's starting to turn up again. So what we're seeing is that from point of sentiment, which is always that secondary indicator, we basically had a lot of bearishness and even panic and a lot of fear, and markets love that. That's when they start climbing the wall of worry. Now, will this last? Nobody knows, but that was one of the triggers. I think it got a little too bearish, and when all these people are bearish, that's usually when the market starts to take off. I mean, there was a classic headline cover, "The Death of Equities" on Business Week. I think it was in 1982, right at the bottom of the market before it just blasted off. So, because nobody was interested in stocks, it was just dead, and that's when the market started to, under the surface, become bullish and basically took off. And here we are 40 years later, sorry, and we've had a just massive run. So, one of the things we're going to be looking at going forward, or the market's going to be looking at going forward, is the key things about the stock market and economic activity. So number one is demand still strong, and we are seeing that consumer debt levels are low and there's cash levels are high. People saved a lot of money during the pandemic, so we're seeing a lot of demand. The second thing is that our profit margin's holding up. So interesting, despite the pandemic, the profit margins actually widened to a record level in 2021. And analysts are predicting that margins are going to stay high in 2022. Again, this is actually counter to what most people thought, that businesses were going to suffer in the pandemic, and it really didn't seem, except for some of the restaurants and a few other sectors, didn't really have a lot of impact. People really were able to pivot and change their business models. So when you look at revenue and profit margins, those are the dominant drivers of earnings growth. And I'll show you in a second in the chart. And earnings growth drives stock prices. So here's the S&P 500 year-over-year operating EPS growth. So you can see in 2021, we had a huge move up, which just surprised everybody. So that's the strongest growth we've had since this chart going back to 2001. So it's going to be critical for companies to keep delivering on the revenue and profit margins. Or if that starts to look like it's weakening because either inflation is getting too high and businesses are going to have to start raising prices past the point that consumers are willing to pay, that will actually knock the market down probably, because economic activity will start to slow. But if they can continue to raise prices to offset inflation, then we could continue to see the rally head higher. And if inflation suddenly, sort of peaks and heads back down, that could be another impetus for, higher prices. So we're sort of at that interesting inflection point, critical point here for what the market's going to do. If we just go back to the NASDAQ chart, so I'll go back to the S&P chart, it's a little stronger. So we've gotten back over, these key technical areas. Now, what would be really bullish if the market can just hold here? It doesn't even have to go higher, but it gets comfortable and starts living above their key moving averages, the 50 and the 200. So that would be actually probably one of the most bullish scenarios. In other words, the market gets calmed down a little bit. We don't have so many, plus 1% days. We have just some calmer trading days. The volatility drops off a little bit, but we don't really go down. We don't get a lot of distribution. We don't want to see distribution days, institutional selling days coming in. That might just kill this rally. So far, there's none. It looks very, very strong. So that's what would be the ideal situation, is that we just kind of pause here and don't make a lot of progress, but just don't make any progress on the downside, but maybe not even progress on the upside. Same thing with the NASDAQ. This is acting a little stronger. It would be great if it could actually get up to the 200 and did not collapse. So, which is where a lot of traders and shorts like to look at that and try to, put their shorts on and sell into that rally. So we'll see what happens. It's a very interesting situation we have in the markets. Always surprising. You never know what to expect. But the whole key is, you have to be flexible. These are the times, especially, it's easy 2 weeks ago to say, well, I'm going to be out of the market and I'll just, it's going down and it's been frustrating. I'm not making any money. These markets can change within a few days and go from super bullish to super bearish and vice versa. So you always want to stay engaged. And if nothing else, our market trend advisory is going to get you in these rallies, get you out of the corrections and of course, the bear markets. And that's just an objective look at the market. So that's why you guys are subscribers. I hope you're using this to its full extent. And well, that's about it for today. I guess we're going to see what happens in the following week. It's looking pretty good for the market, but of course it can change. So we have to be nimble and be ready to sort of take the opposite side of the market if we start getting those signs. But for right now, it's bullish, and you should have some exposure to the market. It could head a lot higher. It could make all-time highs. And if it starts looking like stocks are not working and breakouts are failing again, like we've had for most of 2021, we'll start to exit. We'll also see that in the market count, which will start to drop. And if it gets bad enough, it'll go to zero, and we're back out again. So, follow the indicators and follow the action signals, and it should keep you on the right side of the trend. Okay, we'll see you on next week's video. All right, thank you.